Hi guys, welcome to week 11 of Accounting for Managers. I'm just going to share my screen so that we can get started straight away. Um, this week, like I said, we're looking at week 11, and the topic that we're interested in today is called performance measurement. So how do we measure performance? It's okay to say that you've done well or you've done poorly, but we need to be able to measure it. Okay, and there's a number of things that we're going to talk about there, which I think you'll find fairly interesting. The good thing about this topic, it doesn't matter whether you're a small business, a large business, a sole trader, a large corporation. We all need to have some sort of performance measurement to see how we are performing and to identify areas where we can improve our performance. So, on completion of this lecture, we're going to explain the need to measure the performance of entities, appraise and apply what we call a balanced scorecard, outline common organization structures, what responsibility structures are. We're going to talk about some of the measurement tools. Okay. We're going to talk about environmental and social issues. Okay. We're going to talk about some of the issues that we have with performance measurement. And then we're going to look at non-financial performance measures. So there's quite a bit that we're actually going to be looking at today. Okay. So the first thing is, why do we measure performance? Well, we want to make sure that we've achieved our goals or we've contributed towards achieving our goals. The measure that we are measuring is normally compared to a benchmark to basically be able to say, did we do well or did we do poorly? And those goals, that's usually part of our long-term goals. But as you know, we need short-term objectives to meet long-term goals. And so that's what we're going to measure against, those short-term objectives. With this in mind, entities need to formulate strategies, structure the entity and design processes to make sure that resources are used appropriately in trying to achieve our mission. Okay. Sometimes we might break our organization into different segments or divisions. So if we're looking at David Jones, they might break their organization into geographical divisions, say Sydney, outer Sydney, Melbourne, outer Melbourne, Perth, things like that. Or they might break it along product lines, menswear, women's wear, kitchen, food, those type of things. So there's different ways we can do this. But at the end of the day, performance measurement helps us to evaluate the entity's success, provide feedback for further action, what we did well and what we did poorly, so we can make it better next time. It helps us to also disseminate or localize decision making, and we reward them for good decisions. It can also help us improve commitment and motivation of our employees. Okay. It also means that if we're getting people at the lower level to make decisions for which they're going to be rewarded for or assessed against, it means that senior management can spend more time on the strategic processes that we have rather than the day-to-day activities. We can also assign responsibility, like I said, and authority to that local area, to those day-to-day decisions. Okay. Now, so the performance measurement system could include measures to evaluate the organization as a whole, a division, maybe even an individual manager, even an employee, a customer. Is that customer profitable, given the amount of effort we're putting into it? A product, a supplier. Are they providing the best quality service, this supplier? Or maybe do we need to go somewhere else who can look after us better? Are our processes the best processes available? Okay. So the performance of an entity, as you know, is normally monitored both inside and outside the organization. So it's monitored by management and potentially by shareholders. Okay. When conducting an external evaluation, we look at key data, we compare it against a benchmark, so it could be industry average, the best member of the industry, anything like that, and see if we're doing poorly or we're doing quite well. Internal performance evaluation, this can be a little bit more micro by virtue of the fact that when we look externally, the information that's provided externally is fairly high level, okay? So internal performance evaluation can have a little bit more micro information. And as it says there, it can use information from a variety of sources, internal or external, accounting, non-accounting, financial, non-financial, whatever makes sense. Could even use things like HR information, which would come under non-financial perhaps. Now, with this in mind, I want to talk about the balanced scorecard. Now, the balanced scorecard was developed by two people. Robert Kaplan, now he was from Harvard University, and another guy called David Norton. So Kaplan and Norton. Now, it's had a few iterations over time. Some people have expanded it, some people have shrunk it. It's a concept. It was developed to help entities focus on the factors that help drive the successful attaining of goals, okay? So what it did, it broke performance up into 4 perspectives. And it said that if you can achieve all 4, the company would be doing well. The first of these is financial, okay? What factors do we need to measure so that we can make sure that we're creating value for our shareholders? The customer. What do new and existing customers value from us? So for this one, for example, you might have a measure for how quickly you dispatch orders, okay? That would be a customer perspective. Internal operations. What processes must we excel at? You know, say the distribution arm or something like that. Innovation. How can we continue to improve and create value? So it's actually quite ahead of its time because it just didn't look at financial measures, which a lot of performance measures up to that date had only considered, okay? So with that in mind, they made it broader. So the first of these was the financial perspective. So a lot of financial metrics, okay? Under this, timely and accurate funding data will always be a priority, and managers must ensure that they provide this information. Managers must be mindful that the concentration on financial data does not come at the expense of an unbalanced sports business perspective. So what they were saying there, in the past, a lot of people had only really focused, okay, on the financial perspective, but that wasn't right. You had to look broader outside the organization. It must include other financial data such as risk assessment, cost benefit analysis, and opportunity cost must also be explored. The next one was the customer. You must focus on customer satisfaction. What makes them happy? What are the factors that make them happy? Let's measure those factors to make sure we're meeting our objectives, okay? If a customer is unhappy, they will eventually find other suppliers who meet their needs. Poor performance in this area is a good indicator of future decline. Why is that? Unhappy customers, they go elsewhere. Doesn't matter how good your financials are, if you don't have customers, the company's going to fail. Okay, the sports business, or any business really, needs to develop metrics that look at customer satisfaction. That can be quite difficult for a lot of organizations. But the other thing is you've got to be able to measure them as well, not just develop them. And they have to be meaningful for the organization. Another important thing here, when we talk about the development of metrics, we have to be careful that we just don't have too many, okay? The next refers is internal business processes. Okay. This is going to tell you how well your business is running. Okay. And whether the products or services conform to the customer requirements. Okay. These metrics must be designed by those who know them well. Okay. When we look at these, we often talk about what is the objective. So the mission orientated processes to meet the mission of the organization, and then the support processes that support the activities that try to meet that mission. Now, a lot of these activities can be interrelated. And the reason that I say they can be interrelated is purely for the fact that you might look at a process, you improve that process, that has the impact of then improving customer satisfaction. So it can go across two areas, okay? Innovation includes employee training and corporate cultural attitudes. Again, this can have an impact on customer satisfaction. People are the main resource, hence the sport entity should invest in those people. Difficult to achieve in a sport entity which is government owned? Well, maybe. I think our view on that has changed in recent times. Kaplan and Norton talked about the fact that learning was more than just training. It includes things like mentors and tutors within a sports business. It includes the ease of communication, which allows the organization to obtain help on problems when they arise. It includes embracing technology as well. But if we look at our balanced scorecard, these are the 4 factors. And the idea is that if we can fix each of these areas and maximize their potential, we're going to maximize the value of the firm. Don't forget, they're interrelated. You might improve customer satisfaction, or you might improve internal business processes, so there's less faulty goods produced. The impact of that is that you'll improve customer satisfaction because they'll be happier, and there's a financial impact because you might end up saving money. Criticisms of the balanced scorecard. Some people argue that it only really focuses on shareholders, does not give proper attention to employees and suppliers. I'm not so sure about that. I think it does. It depends how you set it up, to be honest. It does not address adequately the selection of specific measures. Well, that's for the organization to work out what measures are suitable for it, okay? The relationship between some of the measures and their economic impact has never been empirically tested. Maybe that's a criticism, okay? But what I like about the what I like about the balanced scorecard really is the fact that it brings together a combination of financial, but also non-financial measures, which gets the organization to focus on those as well. Now, these balanced scorecards can be used for a fast food outlet like KFC, but it could also be used for an organization like the casualty department of a hospital. It's pretty amazing, okay? Measures and drivers are used to monitor progress towards the goals, and they should be communicated. So people should understand what the KPIs are all about, how they affect them, and how that's going to go towards them achieving the goals of the organization, okay? Key performance indicators are performance measures that are critical. Key, that's the thing. They're critical to success, okay? So it's been argued for a long time that it's not only important to measure an outcome, but it's also important to link the outcome with the processes or drivers, okay, that drive that outcome. Okay. So what this means is that if you want to improve, you improve the process. You don't try to improve the outcome because that's a consequence of improving that driver. So for example, if you want to increase sales, the driver of that may be an increase in the number of new products. And so that's how you reward your management for the number of new products that they produce, because that's the real driver. A manager is normally charged with coordinating the resources of a business unit and therefore responsible for the unit's performance. So there's different types of responsibility centers. Cost center, you ask the manager to manage costs. Revenue center, you ask the manager to meet revenue targets. Profit center, they've got to meet revenue targets, but they also have to meet cost controls. Investment center, they've got to meet the profit, like for the profit center, but they also have to look at things like the capital equipment purchases and those sort of things. Okay. So there's a number of measures we can use to measure performance. Return on investment. Profit divided by investment. For every dollar of investment, how many dollars of profit have I got? DuPont return on investment, very similar. It's just return on sales times investment turnover. The residual income, that's trying to work out how much excess profit my project or my firm is making relative to the level of investment. So I work out my level of investment and then I work out the required rate of return on my investment. And then I say, is my profit greater than that expected return? The last one, very similar to residual income, is economic value added. Okay, in this case, it's profit after tax times the cost of capital times the amount of capital. So they're quite similar, those last two. So to promote business sustainability, there must be some measure of the environment and social performance of an entity. So in the past, we were focused on financial performance. Nowadays, you want to make sure that the organizations has been a good member of society. And we also want to make sure that its environmental credentials are good, okay? This is all associated with the widespread triple bottom line. So triple bottom line talks about the impact on society, the impact on the environment, and the economic impact. Are we making a profit? Some people just say the triple bottom line for an organization is about looking after PPP, people, profit, planet. Okay. Now, United Nations Division for Sustainable Development has published some procedures telling people how they should report on sustainability issues. Now, operation performance provides information on an entity's environmental performance, such things as water use, energy consumption, emissions, have they had any spills of toxic chemicals? MPI provides information on management's effort to influence the entity's environmental performance. So it may include how much staff training have we done? What certificates do we have? And have we met our environmental audit requirements? The next one is the environmental condition indicator. Okay, it provides information about the local, regional, national, global condition of the environment, and it may include monitoring of things like water quality. Okay, we've got greenhouse gases that we have to look after. Okay, and they also talk about a carbon tax. Now, we tried that in Australia, but it was actually cancelled pretty quickly. Okay, so based on that, okay, we can assess the performance of an individual manager. So if they were a customer service manager, we might assess their performance based on customer satisfaction. Or if they're a sales manager, the dollars of sales. We might put a reward system in so that if people meet their performance measures, we reward them and give them some sort of incentive. It could be shares, it could be stock, it could just be extra pay. Now, non-financial performance measures, that's the use of financial performance to gauge an entity's organizational success. Okay. Non-financial measures are more operational in nature and typically should be linked to the entity's goals. They tend to be internal. Okay. So it says here, what are some examples of quantitative and qualitative? Well, quantitative could be sales, profit, costs, anything like that. Qualitative could be customer satisfaction, rework of product, number of injuries, staff satisfaction. It can be a whole bunch of different factors that we would have to consider. Okay. All right. So with that in mind, I'm just going to do that. Well, thanks very much, guys. That's a really interesting lecture, and it's got a really large amount of applicability for our different organizations. I hope you've enjoyed that, and I will talk to you again soon. Thanks very much.